They told you car prices went up because of COVID and the pandemic. That was only partially true. Here's the real story, and how we can get those prices under control. Car prices in the United States are way too high because the same predatory subprime lending practices that caused the 2008 housing crash didn't stop. They merely shifted to the automobile industry. At Pattern.Power.Recognition, we identify underlying systems that shape our reality. If you visit any used car lot recently, you'll notice you'll hardly find anything for less than $5,000. What happened to all the $1,500 cars? Why would they sell you a car for $1,500 when they can simply hike the price to $5,000 or more and force you to get a bank loan at ridiculously high interest rates? Cha-ching. They couldn't do this in the past because banks refused to make loans on older, depreciated, high-mileage cars. Now, with predatory lending practices entering the picture, they suddenly changed those rules. And instead of selling you an older used car at fair prices, they raise the prices and turn those old cars into financial instruments where they charge not only higher prices, but banks charge higher interest rates on top of that. They're basically printing money at the consumer's expense. In the not-so-distant past, banks would not approve loans on older, depreciated cars, and dealers would need to sell those vehicles at fair cash prices. Today, the reasonably priced used cars have all but disappeared, and that causes a domino effect on the entire industry, pushing all car and truck prices sky high. In 2026, the average new car is roughly $7,000 to $10,000 overpriced. New trucks and SUVs are often overpriced by nearly $20,000 or more. Priced a full-size Ram or F-150 lately? So what happened? Many people point to the pandemic and supply chain disruptions, but car prices were already climbing out of control before COVID ever began. The main reason new cars are so expensive today is the result of used car overpricing for predatory financing purposes. That may sound counterintuitive, but inflated used car prices directly push up the cost of new vehicles. Here's how. Over the last 15 to 20 years, banks and financial institutions quietly changed a long-standing rule. In the past, it was extremely rare to finance a vehicle more than 5 years old or with over 100,000 miles. These cars were considered high-risk assets due to rising maintenance and inevitable repair costs. Today, magically, that restraint is gone. Financial institutions now issue loans on vehicles that are 10, 15, even 20 years old, sometimes with over 200,000 miles. This single change artificially inflates used car prices, which in turn hyperinflates new car and truck prices. In earlier decades, once a vehicle passed a certain age or mileage, financing disappeared, and prices dropped accordingly. Buyers could find reliable older cars for a few hundred to a few $1,000s. These were cash purchases, and market forces set fair prices. That system worked fine for both sellers and buyers. Today, instead of selling older high-mileage vehicles at fair cash prices, dealers inflate prices high enough to qualify the car for financing. Why sell a good car at a fair price when they can now force buyers into expensive monthly payments that seemingly never end? High-interest loans replace affordable, reasonable cash prices. Walk onto most used car lots now, and you'll notice something strange. Almost nothing is priced below $5,000. That floor is artificial. Why did banks once refuse to finance older vehicles? Because lending against a heavily depreciated asset almost guaranteed borrowers would end up upside down on their loans. It was financially irresponsible to guarantee a loan on a vehicle that had little to no value. Fast forward to today. Banks now regularly issue high-risk, low-value auto loans. Borrowers, especially lower-income buyers, are forced into high interest rates because affordable cash options no longer exist. Used vehicles are no longer treated as transportation. They are treated as financial instruments for predatory lending. We have heard these terms before, subprime and predatory. They defined the housing crash of 2008. Banks and financial institutions gambled with taxpayer-backed money, issued irresponsible loans, and when the system collapsed, American taxpayers paid the price. Can you say bailout? So, did banks learn their lesson? Yes and no. But did they learn the right lesson? They did learn how to shift predatory lending away from housing and onto automobiles. But no, They did not learn how to stop gambling with taxpayers' money in the first place. While attention stayed focused on real estate after the bailouts, financial institutions sneakily abandoned their long-standing auto lending standards so they could quietly shift their predatory lending away from housing, where everyone was watching, and move it over to the auto industry instead. Vehicle financing loans that once stopped at 5 to 7 years now extend far beyond vehicle warranties and reasonable risk. The result is a growing subprime auto loan bubble. And who pays for it? The taxpayer. And what always happens with bubbles? They burst. This shift affects the entire auto industry. It's why car and truck prices are out of control. When affordable used cars disappear and buyers are forced into loans, they compare monthly payments and realize a new car isn't much more expensive than a higher interest older used car. That eliminates the low-cost option entirely. Dealers respond by dramatically raising new car prices, knowing buyers are trapped either way, without the choice of a low-cost reliable used car. Now nearly all used cars are overpriced, especially reliable ones. And new cars are even more overpriced. Consumers lose in both directions. So what can be done to fix this problem? First, contact your representatives and push for legislation that limits federally insured auto loans to vehicles no older than 7 years or 84 months. Mileage caps should also apply, 100,000 miles for passenger vehicles and 150,000 for commercial vehicles. Anything beyond that is a high-risk, depreciated asset and should not qualify for federally backed financing. Second, protect yourself. And this is important. Never ever finance or make monthly payments on a vehicle sold as is, meaning without a warranty of any kind. You are assuming too much risk, and when that vehicle breaks down, you're stuck. If you do decide to make payments on a vehicle, make sure the seller will guarantee the vehicle functions properly. In other words, make sure the dealer provides you a warranty while you are making payments on the vehicle. Otherwise, you may end up paying for a vehicle you can't even use. There is nothing worse than the nightmare scenario where you are stuck making monthly payments on a broken vehicle and you can't even save up for the repairs because the payment and interest rates are too damn high. That's predatory. In fair business transactions, risk must be shared, not dumped entirely on the buyer's side. The current practice of financing older, high-mileage vehicles is more than predatory. It harms consumers long-term and is possibly leading toward another financial crisis. First, dealers are inflating prices to make the cars available for financing, where greedy banks and finance companies can make a large enough profit. Buyers end up having to buy a $5,000 car that in reality might be worth $1,500. Since that car may be over 10 years old and out of warranty with high miles, now the transmission goes, which is normal for higher mileage cars, and the repair cost is roughly $4,000 for the transmission. Now the consumer is stuck making monthly payments and having to pay for a huge repair bill, and with older vehicles, once one thing goes, it usually means more items will also wear out. This is a terrible position for consumers to be in, especially those of modest incomes. In the past, consumers could make a more reasonable choice. Either make monthly payments on a newer vehicle that has a warranty, or pay for costly repairs on a lower-priced used vehicle that's purchased for cash in as-is condition. Today, the second option is no longer available. There is no low-price cash option, as greed-based financial institutions are attempting to force all consumers into high-interest loans, even on older vehicles that will require expensive repairs. Additionally, banks require buyers who finance vehicles to maintain full insurance coverage, which is an added expense for consumers, but is intended as protection for the bank's investment. The financial institutions and dealers want to minimize their risk and have all bases covered while the buyer remains exposed and is forced to assume all the risks. And when it comes to older vehicles, the question is not if it will require expensive repairs, but when and how much. Stop and really think about this. Protect yourself by never financing or making monthly payments on any vehicle that does not come with a warranty, meaning any vehicle sold as is. Instead of sharing risk, it all falls on one side, the side that can least afford it. Sneaky dealers may try to sell aftermarket service contracts instead, as a way to confuse buyers into thinking they are reducing risk. Many of those service contracts are designed to collect premiums, not pay out claims. They take your money in, but when it's time for repairs, they find a way not to pay. Fine print is often used to deny coverage when repairs are needed, further hurting consumers. If a seller cannot warranty a vehicle, federally backed financing should not be allowed for it. If a vehicle is too old and high mileage that a dealer refuses to offer a warranty, then how on earth can a bank turn around and give out a federally backed loan on the same high-risk, depreciated asset? It just doesn't add up. Requiring banks to no longer make high-risk, predatory auto loans is not anti-business. It is pro-financial responsibility. The federal government backs banks with taxpayer dollars, and banks in turn gamble that money on depreciated, high-mileage older vehicles, which are guaranteed to need repairs. Whose money is at risk? Yours, the taxpayer. Can you say bailout? Everyone's rear ends are covered except for you, the consumer. Financial institutions can still profit without repeating the unethical failures of 2008. But greed cannot be allowed to override responsible lending, and it's happening right now in the auto industry. Because when this bubble bursts, history tells us exactly who will pay for it. We can fix this before it's too late, but it is up to all of us to share this information as far and wide as possible. No one else is coming to save us. Once we make it unlawful for banks to issue predatory auto loans on older, high-mileage vehicles, then prices will have to adjust downward across the entire industry, new and used vehicles alike. Following is a step-by-step process of what we need to do right now. It's important to reach out to the people who make the laws and set the rules, not just watch videos online. Here are the key people to reach out to: your U.S. representative. Every state has at least one member of the U.S. House of Representatives. They introduce and vote on federal laws that affect banking, lending, loan disclosures, and consumer protections. You can find your representative by entering your zip code at house.gov. Reach out to your U.S. senators. Every state has 2 senators. They also vote on federal laws and sit on committees that oversee financial regulations, including auto lending and consumer protections. You can find contact information for your senators at senate.gov. These are federal lawmakers, the people who can push national rules that stop predatory auto lending and protect consumers. Contact committees with influence. Some congressional committees have extra influence over banking and credit policy. The Senate Banking, Housing, and Urban Affairs Committee, which oversees banks and financial institutions. The House Financial Services Committee, which oversees lending and credit practices. Calling or writing letters and emails to committee members can amplify your message. Contact federal agencies that matter. You can also file complaints and push for rule changes at agencies responsible for consumer financial protection. The Consumer Financial Protection Bureau, CFPB. This is the federal agency that enforces fair lending rules and protects consumers from abusive practices. What do you say when you contact them? Be clear and direct. Identify yourself as their constituent, meaning you live in their district or state. Tell them that you're concerned about predatory auto lending and overpriced vehicles. Ask them to support legislation that limits high-risk loans on older vehicles and protects consumers by restoring responsible lending standards. Request they support stronger protections through the CFPB and oppose easing regulatory standards that harm consumers. Even calling a staffer on these issues helps. Offices tally phone volume and emails to gauge public concern. Here is a sample script of what you can say when you call or email your representative. Hello, my name is blank and I live in blank. I'm calling as a constituent because I'm concerned about predatory auto lending practices that are driving up both used and new car prices. Banks are now financing vehicles that are 10, 15, even 20 years old, often with very high mileage. This inflates used car prices and forces buyers into high-interest loans, leaving many people upside down. I'm asking the representative or senator to support legislation that limits federally insured auto loans to vehicles no older than 7 years, with reasonable mileage caps. This would restore responsible lending standards, protect consumers, and reduce price pressure across the entire auto market. This issue affects working families and needs to be addressed to protect consumers and prevent another subprime lending crisis. Please, let the representative or senator know this issue matters to me as a voter. Thank you. You can find this script located in the description of this video. Your call or email will make a difference. Every single one counts. Remember, you do not need to be an expert. You do not need to argue. You do not need to convince anyone. You just need to reach out. Calls are logged and counted, not debated. Mentioning as a constituent is a key point to let them know you are a voter in their district. Why this matters. Legislation and regulatory rules are not written in stone. They change when enough people demand fairness and accountability. Your voice, combined with others, can push lawmakers to tighten lending standards, protect consumers, and alleviate the upward pressure on both used and new car prices. Don't wait for someone else. It's up to each one of us. We can get this done together. Please, if you are unable to do anything else, share this message with as many people as possible. That's the only way we can win against corporate greed. Also, please support our outreach efforts by clicking the gratitude link in the description to help us spread this message far and wide. Thank you. Like, share, and subscribe for more pattern, power, and recognition content, and support PPR.